what are the simple tips that you can give people so that whatever be their level of income right now, they can start saving?
So the first thing to avoid would be these insurance schemes which lock you in for a very, very, very long period.
In your book, the 80-20 Money Makeover, you speak about doubling money over time. How many doubles do you think are required for an individual to get financial independence?
If you take a very simple paper, an A4 sheet, and then if you fold it 42 times, any guesses where you will, how thick the paper would be?
How can someone who's at 40 now they've cleared all the debts but they don't have any form of savings right now at the age of 40?
Right.
They want to earn 20 crores. How
Right.
can they go about it?
Right.
Based on your experience, are the repeated mistakes that people make when it comes to investing?
See, there are a lot of mistakes, but I think the most important mistake is that
Hey, hi Arun, welcome to the show. Arun, to basically for our audience to understand more about you, if you could just tell us what your role as VP, Head of Research at FundsIndia is.
Yeah, hi Kishore, thank you so much for having me on the show. So I head the research for a wealth management firm called FundsIndia.
Okay.
FundsIndia was one of the earliest pioneers of digital wealth tech. Now it's like a very common word.
Right.
But we started way back in 2008. Where
Okay.
Probably we were one of the earliest pure digital wealth management firms.
Mm-hmm.
Today we are probably close to, we've just crossed 20,000 crores in assets.
Mm-hmm.
We're almost around 17 years we've crossed.
Okay.
And we also have close to 25 lakh customers.
Okay.
Now, in terms of what I do in the role of head of research, essentially the idea is simple that
Okay.
there are different clients who have different
Needs.
objectives or needs.
Yeah.
In essence, the idea is how do we create a good investment experience for them. By that, I mean that there are just 5 levers
Mm-hmm.
which you can use to build returns. So
Okay.
the first one is how do you combine different assets.
Okay.
By assets, I mean equity, gold,
Real estate,
income or
fixed
debt or
deposit, yeah.
real estate. For all practical purposes, at least in India, it's mostly gold, fixed income or debt as it is called, and equity. Real estate is still nascent. We have some REITs coming in, but it'll take some more time.
Mm-hmm.
So the first basic lever that you have is how do you mix together these
Asset
assets.
classes. Okay.
And then based on each and every asset class will have its cycle where at some points in time, it becomes very extreme, either on the top or either on the bottom. So there you might want to adjust these assets. So broadly, this is called in technical terms asset allocation. But broadly, the idea is how do you mix it up and manage it over an entire cycle. The
Got it.
second lever is within each and every asset, which is equity, debt, and gold.
Right.
How do you build a strategy? So within equity, you might want to blend different investment styles.
Mm-hmm.
You might want to blend different investment things. So there are different ways to construct the portfolios.
What
So
do you
again,
mean by investment style, Arun?
So investment style would mean that so there are say at least 500 top stocks which are mostly which mutual funds, PMS or AFs can
Invest
can
in, yeah.
And there are different fund managers. Now not all the fund managers will pick the same stocks, and for each and every stock there will be different parameters on basis of which each and every fund manager will pick these stocks. Broadly, if you put them together, it will be like fund managers will evaluate the business quality of that particular stock or the company. Then they will look at the management. Then they will broadly look at the valuations. Now, obviously, you don't get a very, very good business with very, very good management at very cheap valuations. There
Right.
will always be a trade-off that every fund manager will need to do.
Right.
Now, different fund managers will have their own versions of where they will take the trade-off. So, there will be fund managers who will say, I want the highest quality companies. So,
Right.
you can assume that somebody like, say, Apple, HDFC Bank, Asian, so which are been there, done that for a long period of time.
Yeah.
But they'll always be available at expensive value. So, I'll take a compromise on the valuations, but no compromise on the quality. So, these
Yeah.
are called quality biased
Got
styles.
it. Got it. Yeah.
Similarly, there'll be people who will take compromise on the quality, but not on the valuation. So like that, you have different approaches. So
Style.
this
Got
is what
it,
I
got it.
mean saying that
Got
you
it.
combine different approaches together.
Got
So
it.
this is the second lever that we have. The third is within these approaches. So let's say I decide to go for quality as an approach. Who is the best investment manager to pull off this approach?
Okay. Got
That's
it.
the selection part of it. And the fourth lever would be that there will always be some risks emerging in some small pockets. While the overall asset class might be okay, but you will have pockets of danger arising often. So that is where we try to figure out where the pockets of dangers are and try to avoid them. So we have an early risk warning system for that. And the last part is where we look at extra return opportunities. So these are slightly higher risk ones.
From here, let's segue to a money mindset. What are the one or two behaviors of that keeps them poor?
The single most important thing is that most of us have a spending issue. The challenge nowadays is that a lot of people are struggling with this whole gap where the spending is more or less equivalent to their earning
Income,
or
yeah.
it is in fact more than
Higher.
that because you are also getting
Borrowing.
borrowing has become a lot more easier compared to what it was 10 years. So I think overall the biggest issue would be on the spending discipline.
So
The
living
moment-
beyond your means is the
Correct. I think that's the core item. Once you figure that out and you get a saving, and the corollary of this is a savings habit. A lot of us wait till we have a large enough a salary to save. But again, it's a habit. So unless and until you start small, it's very difficult for you to suddenly one day. It's more like a mindset. So I think both not overspending and also starting the habit of savings a lot early.
Okay.
I think these two are very critical. And post that again, where are you putting these savings? While you might be a good saver, but if you use very traditional instruments like say most of your investments go into FDs. So again, are you able to maximize your savings in terms of returns? That can be the third, but I think broadly, but it's the first two which is the real problem. The third is still a lot more easier to solve.
Arun, I see you stressing so much on savings. Let's get into saving strategies then. What are the simple tips that you can give people so that whatever be their level of income right now, they can start saving? What are few tips that you have?
See, first, the basic starting point is more than the tips, right? The real starting point is you need to have a why for that savings, because generally I see that if you generally start saying that I will suddenly start saving 10%, 20%, then it's not motivating enough. But some people generally, I've seen the people there are very rare cases who are like by discipline they almost save because it's like a habit for them right from their young childhood. But for most of us, we need a core reason. It might be anything. It might be that I need to reach financial freedom or I need to reach X amount by this thing. So I generally would prefer that if you have some
Why? Okay.
why to your this thing, then it becomes a lot easier. And in terms of some hacks that you can do, the ultimate idea is that you need to automate this. Otherwise, this is not going to happen. Because if you think about the number of things that are working against me to make me spend is too high. So if you depend on your willpower to do it, it becomes very, very hard. So whatever is your savings route, either you do it through mutual funds or anything that you prefer, the idea is just automate the whole thing. So SIP, in other words, is a very simple automation tool.
Absolutely.
Where you say on this particular day, move X from my account and then put it in the Y fund that I like.
Yeah.
Right. So I think level 1, you automate this. And level 2 is that start seeing your salary in terms of percentages. So I call it the fish approach, where you look at the first, which is your fixed expenses.
Okay.
As so most
Rent,
of us would have rent. Electricity bill, petrol bill, internet. So these are like inevitable stuff. So roughly figure out what is that number and look at it as a percentage of your salary. And the second thing is how much do you want to save? Generally, in your 20s, it's very difficult, but at least try to gun for 10-20%. 10% is a lot more doable. But probably in your 30s and 40s, you should start looking at a very high number, at least at 30% or more.
Right.
30% is a very, very good number or a very good benchmark in terms of, let's say if you're getting
Percentage of
100
savings,
as salary, at least do 30 as savings.
Yeah.
Obviously, different people are at different contexts, but broadly, right? So, and this would be the savings part of it. And the H is whatever is the remaining is you're happy to spend. So broadly, if you can see it in terms of percentages, so let's say I have 50% as fixed, then I have another 30% as savings, and I have another 20% as my happy to spend. Then it becomes a lot easier. Then you know which is the lever to move. But let's say if your fixed in expenses are say 70%, then you know it's very, very difficult because then you start saving. So level 1 and level 2 is in terms of hacks. You can create 2 savings bank accounts. The first savings bank account is where your salary hits, and whatever is your fixed amount, let's say you are earning 1 lakh, and let's say 50,000 is your
Fixed expenses.
So keep 50,000 there, and let's say you have decided to save 20,000 every month. So the 20,000 becomes the second bucket. So both of these, so 50,000 plus 20,000 stays in your first bank account, and then whatever you are spending, the remaining 30,000 goes into your second bank account. So whenever you're spending on all the stuff where you like, or which is discretionary, where it's optional, like you go to a movie, you go to a pub and all that, you do it through your second bank account. And by the second or third, automatically you knock off this 20,000 through an SIP. So this 50,000 goes into your
Fixed expense.
And by the end of the month, you don't need any fancy tracking apps. All you need to do is the second bank account fully emptied.
Yeah.
And if it is, where did you spend?
Yeah.
And then so you get a hang of these percentages.
Got it.
And over a 2-3 month cycle, you will broadly know which are the levers available. And then post that, you can figure out how do you get the savings percentages to be at least 10% to begin with. But net a good number to look at would be 30%.
What do you suggest that right out of college, first job, first 10 years, what are the 4-5 things that ideally someone should not be spending on?
So the first thing to avoid would be these insurance schemes, which lock you in for a very, very, very long period. And the funny part is that after 3-4 years, once you realize that this is probably not a great place to invest, it's very difficult for you to get out because the penalties are very, very high. So level 1, don't invest in these insurance products where you don't know the underlying returns, where it says invest X over 10 years and then post that you probably get 2X over 20 years or 30. So it's structured in that way. It looks very attractive when you forget the fact that you need to account for inflation. So one of the hacks that you can use is that whenever you get sold these kind of products, you can just get a brochure, put it in ChatGPT, and then say calculate XIRR. XIRR is what is the underlying returns. And in probably 20 seconds, it will throw up a number which is around 6% or 5.5%. So whatever is the scheme, just throw. And roughly in India, inflation is roughly around 5-6%. So in that sense, for you to lock your money for such a long period doesn't. So this is the first thing that you should avoid. The second thing is there are stuff called Ponzi schemes which will promise you 5%
monthly return
per month, 10% per month. These are basically what happens is that your money is taken. Well, let's say I say that there is then usually there'll be some fancy name given saying that I have figured out a trading approach. There is I do currency, and here is a technique using which I can do 5% every month. So why don't you try it out? So let's say Kishore, you give me 1 lakh. So what I will essentially do, I don't have anything fancy here. With your same 1 lakh, I will start giving back 5,000 of your same 1 lakh back to you. But you have no idea that
the
it
principal
is
is
from
coming
your,
down.
because your 1 lakh is with me and you have no access to your 1 lakh.
Yeah.
And I might even design an app which just shows the same 1 lakh as such. And I keep giving it to you, and then after 6 months you get convinced that, hey, this is probably working because for 6 months it's worked.
High return investment,
And then more and more people come, and it's a scam which has been running for ages. Even recently in Vellore, there is a scam called IFS where the numbers are anywhere between 10,000 crores to 15,000 crores is what the numbers they're talking. And inevitably something like that happens. So this is something that you need to be aware of. The third thing is that trading in F&O is very, very risky. There is SEBI coming out with statistics every year that almost 91% don't actually.
Zerodha gives that disclaimer at the start
in fact,
itself.
Zerodha's founder himself says that in his entire platform, only 1% is able to beat FDs on a 3-year time. So it's a game where it's insanely difficult, and mostly the guys who actually make money are the proprietary desks who are run with several
algorithms,
algos and all that. So it's not a simple one man who's making a lot of.
Can you repeat those first 3 for the interested audience?
So level 1 is
Just
all
that
these
pointer.
insurance schemes which have
The
which
ULIPs
give
kind
you-
of schemes.
ULIPs kind of schemes which give you
Life insurance,
guaranteed
endowment policy kind of a
policies
thing.
and all that, which give you
That's
guaranteed returns.
Yeah.
And the second one would be your Ponzi related schemes.
Yeah.
And the third one would be the trading and F&O.
F&O. Yeah.
These are 3 things that I think everybody should avoid, not just initially, throughout you should avoid.
Arun, from here, let's move to the power of compounding. In your book, the 80-20 Money Makeover, you speak about doubling money over time. How many doubles do you think are required for an individual to get financial independence?
Right. So, see, the idea is that compounding is a very hard thing for the human mind to process. While you see a lot of quotes saying compounding is the 8th wonder and all that, but the reality is that none of us are able to process it in our mind, and hence a lot of us tend to underestimate it.
It's also
there are different cuts of explaining this. So one simple way to do that would be that say if you're running a simple SIP, that is any monthly investment,
right?
And hypothetically, let's assume you're able to make 12% on it. So 30,000 monthly, and then you are making 12% on it. For you to reach the first 50 lakhs would take you somewhere close to 8 years, right? But the next 50 lakhs doesn't take 8 years. It takes half of it. It takes only 4 years.
Yeah.
And then the next 50 lakhs takes you only
2
3
years.
years.
3 years, okay.
And then it comes to 2. By the time you've crossed your 20th year, almost every year you end up making the same 50 lakhs. So the crux of this is that initially what took you 8 years, at some point in time after the 20th year, takes you only 1 year.
Yeah.
So it's very hard for the human mind to process because all of us are able to relate to what happens to me in the next 1 year. So the early part of it is very, very boring and very, very painful because it takes a very, very long time for you to see any meaningful amount.
Yeah.
And then it's only in the end that it starts to kick. Now, if you ask me why, it's a very simple thing that the moment. So from 1 crore to the next 1 crore is it requires 100% returns.
Yeah.
But from 2 crores to 1 crore is only 50% return.
Yeah.
So which means as your base grows, which is what you say that money starts working for you because the returns might be the same, but the impact of
in value terms it is very different.
On a 10 crore portfolio versus a 10 lakh portfolio is way
absolutely
different in terms of what it brings. So now obviously this is also, I mean, this can help you understand that on the longer run, in the short run it is very slow, but in the longer run it helps you. But how do you think it through is where the doubling as a concept becomes a very interesting way to think about it. If you take a very simple paper, an A4 sheet, and then if you fold it 42 times, any guesses where you will how thick the paper would be? It will almost get you close to the moon. So that's just 42 times a simple paper getting folded will take you close to it. So which is why this doubling is a very, very hard thing for the human mind to process.
Also, Arun, because human beings can understand something that is linear.
Correct.
The moment something is exponential, we can't process it so easily.
Correct.
And the example that you gave also, right? The percentage returns might be the same. For example, I am having a saving of 1 lakh.
Right.
I am getting 10% returns. You are also investing in the same stock or mutual funds. You are sitting on a base of 1 crore, same 10% return.
Right.
You make 10 lakhs out of it as a base.
Right.
I just make 10,000 more and it's too small. I've not earned much. So I think that point is extremely useful for people to comprehend.
So the way this I mean, there's a very famous investor called Ramesh Daman. He gives this example that, hey, if you start with 10 lakhs and then you can double for say 10 times, you almost end up with 100 crores. So the way to start thinking about is that for the first 5 doubles, so 10 lakhs, the first double will take you to 20 lakhs. Second double will take you to 40. Third will take you to 80. Fourth will take you to 1 crore 60 lakhs. Then the fifth double will roughly take you to 3.2 crores. So 5 doubles takes you to 3 crores. If you do the same math, the next 5 doubles will take you from 3 crores to 10 crores. So the way to start thinking about it is if you start looking at very large goals, say I want to build 1 crore and you are somewhere at 10 lakhs. Now 1 crore seems like a very, very tall stretch because at 10 lakhs you're not able to see it. But if you convert it into how many doubles do you need, then you know it's roughly 3 doubles and I'll get somewhere close to 80 lakhs. And then it's a lot more easier. Let's say you are somebody at 6 crores. And then if you say, hey, you can probably become 100 crores, then it's very hard for somebody to process. But then if I say it requires only 4 more doubles at 12-15%, then probably it's like 5 to 6 years. And then you need another 20 more years or 25 more years, you will definitely get there. So the idea is that if you start thinking in terms of doubles, your end goals become a lot easier. Now the whole thing is how do you figure out how fast can you double? So one is you pick a big number and you say how many doubles do I need? The next parameter is how fast can I get there? So which means that for every double if you get the timing, then broadly you're there. Now roughly there's a rule called 72. Rule of 72, where whatever is the returns, 72 divided by the return will roughly give you the time period. Now equities generally historically have given 12 to 14%, 12 to 15%. So roughly which means you will double every 5-6 years. Now the kick is that how do I double in 3 years? Now for that you need 25-26% return. Now the question is, for that you have to be an insanely great investor. Now the simpler way to do it is that while your investments might give you 12 to 15%, the remaining gap of another say 10-15% is what you can provide as your savings. So let's say you have 10 lakhs and you calculate 15% of 10 lakhs. So that will be roughly close to 1.5 lakhs. Now if you can put it as your savings, that 1.5 lakhs, so suddenly you find that while you are adding 15% to the growth, and your portfolio might also add another 12-15% to the growth. So overall you end up growing at at close to 25 to 30%.
Yeah.
So which means roughly you end up doubling close to 3 years. Now obviously your equity returns might not be linear. You have few years which are doing great, but on a 10-year basis they average.
Average it, yeah.
So if roughly somebody can maintain a savings as a percentage of portfolio at 15%, then in 10 years you can do 10x.
Yeah.
So the way to start measuring this is you also start calculating what is your savings as a percentage of portfolio. Generally what we do is we calculate the savings as a percentage of our salary, but we don't do it as a percentage of our portfolio. Now generally I've seen people who made phenomenal money over long periods of time have had an insanely high savings as a percentage of portfolio in the initial.
Wow.
Yeah, at some stage it will become difficult. So let's say I have a 10 crore portfolio. Then to maintain
can't
it
say
at
1
10%,
crore,
then I have to save. But that's okay. But then you have lesser worries because your portfolio will take care of you. But at least I think at the early stages, it's a very good number to measure.
Oh, that's brilliant approach. Yeah. And also, Arun, typically, if people can understand compounding better, there are three levers, right? Either the one, how much you invest,
Right.
rate of return, and the runway, the tenure.
Right.
I think you can play around with these things.
Right.
You don't have so much control over savings or this one, but in terms of the strength to do it longer
Right.
and get the fair amount of returns, I think that will help in compounding. So when you're speaking about compounding, Arun, how can someone who's at 40 now they've cleared all the debts and how, but they don't have any form of savings right now at the age of 40.
Right.
They want to earn 20 crores. How can they go about it?
Right. So let me probably start with a 20-year runway, and so that you broadly get a gist, and then obviously based on your time runway you can adjust, and then so let's say somebody does a simple 10,000 rupees SIP, and you are able to generate say around 12%, right? So 10,000 at 12%, 10,000 monthly, 12% returns. If you do it over a 20-year cycle, you roughly end up close to 1 crore. So which means with this 20-year runway, if you are gunning for 20 crores, you need 2 lakhs per month.
Right.
Which might seem like a tall stretch for a lot of people.
Right.
Now the other way to think about it is that your salaries are not going to be constant.
Yeah.
Because obviously your salaries are going to grow, and hence your savings will also
Quantum
be
also will
growing
grow.
with your salary growth.
Right.
So you can assume that you are able to grow your salary at 10%. In that sense, for the same 10,000 rupees SIP, but with the only additional clause that you will not keep it static. Next year I will make it 10% higher, which is 11,000. Next year I will make it probably 12,100, and so on and so forth. If I do it, then for the same 10,000 increased by 10% every year, and for a 20-year cycle, I'll end up making 2 crores. So if I can add this little hack that I will also increase my SIP amount every year, then instead of 2 lakhs required per month, your amount dramatically drops to 1 lakh per month. Right? And then you can say that if I can extend the time a little more, so instead of say 20 years, I bring it close to another 5-6 years, then suddenly the amount comes down as low as 40,000 per month. So which is why the trick is that after 20 years, every 1-2 years becomes very, very dramatic in terms of, so which is why the earlier you start, that becomes the biggest advantage for you. So I think overall these are how you can play around with the numbers. Don't do a static SIP. Always do the 10% increment SIP, and just play around with the timing of it. Then based on your your comfort, you can get to a rough realistic number. Then the challenge is how do you do consistently over a 20-year cycle.
So based on your calculation, say roughly around 25 years, 40,000 per month. And then
you do
increase 10% every
roughly
year.
At the 26th year, you roughly get there. And if you're lucky, you might get more than 12%.
Absolutely.
And then you might get a one-time here or there. See, generally, good things also happen in life. Right? It's not, so we are probably assuming that it will all remain static. But it's a good, if you have a 25-year, 26-year
horizon, then it helps.
It's a very, very doable number.
Yeah. Arun, what do you think based on your experience are the repeated mistakes that people make when it comes to investing?
See, there are a lot of mistakes, but I think the most important mistake is that past performance becomes one of the biggest determinants of what comes into your portfolio. So every time there is something which is doing well, you get
tempted
excited
to go
by
invest.
It. So today, if you look at it, people would. So a year back, it was everybody wanted small caps. Today, it didn't do well for a year, and so people are a little jittery. Now everybody wants to do silver. The key question is, why didn't you do it 3 years back when it was probably the right? So at all points in time, there will be some fund sector metal, something which
Based
is
on a
doing
trend
well.
you want to follow.
Yeah, so you don't. So most people don't have a portfolio approach. They have a product or a what is exciting comes into your portfolio. So over a period of time, what happens, and then you after 2-3 years you find that it's not doing well. Then again you come out of it. Again you enter something new, and we've done some work around it. We just put together all the top 30 funds each and every 3-year period. And then we asked a very simple question: what happens to these top 30 funds in the next 3 years? So these were all diversified funds. We put together all of them, and we said we ranked the top 30 out of probably 180 or 200. Then what happens to these in terms of ranks the next 3 years? Generally, we found that most of the top 10 ends up becoming somewhere around 150 to 200. Again, we reverse the question saying to get the top 3 or top 10 funds of today or the last 3 years, I needed to buy it 3 years back. So at that point in time, what was the ranking for the previous 3 years, which I would have had access to?
Got it.
Again, we found the same thing, that most of these were ranked probably 150 to 100. So most of these were ranked very, very low. So it was almost impossible for you to get it, which is why the approach of mixing styles make a lot of sense. So level 1, the biggest problem is that you go by returns, and hence your portfolio, you add a lot of funds or stocks, then again you exit these. So what happens is that after a point in time, sometimes you don't exit, so your portfolio almost becomes 20 funds, 30 funds, and each and every fund in itself will have 60-70 stocks.
Yeah.
So you put together 30 funds, it's almost impossible for you to beat a simple passive index.
Right.
So I think, and the second bigger mistake is that nobody measures the overall portfolio performance. Where it might look very rudimentary, it's very, very rare for people to actually measure their overall portfolio performance.
What's your view on rent versus buying a home?
You start with a very simple 3-filter test, that if you want to buy a home, just ask yourself that are you going to stay in that city for 10 years?
Okay.
So
That's
the first
one.
thing,
Yeah.
right? And then the second question that you ask is that do you have a stable career and a stable personal life? Because with chaos around that, you don't want to get locked in a large EMI.
Right.
And the third thing is it affordable to you? So in that sense, it can roughly be say 3x or 4x of your salary. And then can you put in at least 30% of that less, and the EMI should come to roughly less than 1/4 of your salary. So if you're earning 1 lakh, preferably not more than 25,000 as your EMI, because otherwise if it is a 60,000 EMI, you might feel like it's okay, but then you have to run your family with 40% for at least the next 3-4 years till the time you get a reasonable salary hike. So it will put unnecessary pressure on you. So this is the first filter, that can you do all this. Then you take an emotional lens, saying that if you don't rent, what is the if you rent, the advantage is that you are free to move anywhere. There's no EMI pressure. It's some rent that you pay.
Got it.
And you have a lot of flexibility. So this is the emotional part of it. And then if you go for an own house, then obviously there is happiness. It's a status symbol. Then you don't need to deal with tenants. So then you calculate for you, out of these two, what is emotionally, where are you aligned to? And then the moment you put all these three things together and you say emotionally, I do want to buy a house, then the last filter you ask is how do I get the right price? Real estate again goes through cycles. So there are 10-year stretches where it doesn't do well. And so in at the end of it, if you're buying, then it's great. Probably we are almost after, like from 2011, we did not make any money in real estate till 10 years. So that's probably a good time to enter. But if you got caught in 2011 at the end of a cycle where real estate almost did 15% per year, then you got caught for the next 10 years. The second thing that you can ask is, in terms of the area, what is the development prospect, so that you roughly get some odds by your side. And the third metric that I like to see is what is your rental yield. So let's say a 1 crore property and you think that you will get 3 lakhs as rent for the entire year. That means the rental yield would be 3%. Now that you compare with the loan EMI that you're paying. So if the loan rates are say 10%,
okay,
and then you are paying only, then the rental is 3%, then it becomes, so you can look at the difference. Generally, if the difference is more than 6%, it's very expensive, because 10% you're borrowing, but you're getting only say 2% or 3%, then it becomes very expensive. But if you're borrowing at 8%, and then if you're able to make say 5% on it, then the spread is very limited. Anyway, that spread will get taken care by the house appreciation. So then it makes it's reasonably. So you can look at, so the broad thumb rule is, if the gap is less than 4%, then it's a good number. 4 to 6 is okay. But above 6 means that the price is not right. So all three put together, you can decide how to decide on this, whether you want to buy a house or not.
what are the few books that you would recommend on personal finance for the audience?
Yeah, not any very complex books, but these are very simple books that anybody of us. So one is obviously Psychology of Money, which gives you a behavioral lens to
Morgan
that,
Housel,
which is super popular. And then for Indians who are looking to start, Monica Hallan is a great author. She has a book called Let's Talk Money. So that's like a very good introduction for somebody who has zero clue on how to manage their money.
Let's
and
Talk
probably
Money.
my book
Okay.
would be the complementary to that. Like
Okay.
it was also written in a way that you get the basic exposure through that, and then this can be a very good second book after that.
Oh wow.
And then there is also a book called Just Keep Buying by Nick McGwilly. It's a very
Okay.
interesting book. These are three books which
Easy
I think
to read or
very
difficult?
very easy to
Just keep
read.
buying.
Just keep buying. Where
Wow.
basically the idea is if you just keep buying every month, you will be sorted over a long enough time frame, and this works across countries. It's a very simple premise, but you have very very interesting insights coming out of that book, and it's all data backed. So I think these three books can be a very good starting point.
Arun, you are the author of the book 80/20 A Money Makeover. What inspired you to write the book, and what was the learning while writing this book?
Yeah. So what inspired me was very simple. I was already writing a blog. The idea
Yeah.
was
80/20 Investor. That
yeah,
blog,
I was getting. I mean, like just by luck, I got into a decent sized wealth management firm, and hence we got access to a lot of fund managers, a lot of very large institutions, and all that, and hence there was a lot of learning which was probably and most of what we were learning at that point in time was mostly came from the US side. So there was no practical somebody on the ground, somebody who's seeing the client behavior and in terms of how does a wealth manager do it and what are the mistakes that we ourselves do. So then I started writing a blog basically with the intent that whatever I learn, I will keep sharing it out. But that was a lot easier because it was only one simple topic per week, and I used to run it for a very very long period. I mean, it still runs. But then at some point in time in COVID, when I had some more time, I just thought anyway I've written it for probably like 5 years. There's enough content to like put it together as a book.
Oh wow.
And why don't I try it out? But then I realized that it's a lot more harder to write a book because to structure it is where the real problem is. But yeah, it took almost 1-2 years of writing, and another year figuring out a publisher, then another year publishing. So it's almost been a 4-year journey. But the real takeaway for me was that more than, I mean, obviously you want the reader to understand it as simple as possible, but you also become a lot more clearer in that sense. So writing is not just a process that you do for the outside world. So I think in that sense, whether you become an author or not, everybody should attempt writing because in a way it is a way to clarify your thinking. So just like how you go to a gym to exercise your muscles, the way to exercise your thinking is writing. So I think whether you publish it or not,
keep writing.
Small articles, a small blog, and with ChatGPT and all that, you can write some really crappy version of your thoughts, and you can
structure it better.
Structure it a lot better. But at least
the ideas are yours.
The ideas are yours, and then you get a lot more clear in your head. So I think it's a very enjoyable process in that sense. Whether I write another book, I don't know, but at least the blogging and writing, I would suggest it to anybody listening.
That's great. Yeah, great. Yeah, so Arun, from here, let's move to a couple of personal and closure questions. If you could just tell a little bit about your family.
So we are a very nicely set up. We're all based out of Chennai. So me, my wife, and we have a 1.5-year-old daughter called Mira. My wife's name is Shalini. She's an entrepreneur. She runs a dessert chain based out of Chennai called the Brownie Studio.
Okay.
So this is our family, and my mom is my neighbor.
Oh.
My mom and my youngest brother. We are 3 brothers.
Okay.
My youngest brother is with my mom, and my middle brother is in my top floor. So almost in the same apartment.
Oh, wow.
We are almost
closely
like a
knit family,
but with 3. So we have a nice setup there. My mom is retired. She was a railway employee.
Okay.
Both my brothers work for the corporate sector. So so that's pretty much
great. At work life, Arun, any productivity hacks that you have learned?
See, again, generally the way people think about productivity is like, how do I do X number of tasks in as little
time as possible.
Somehow I've moved away from this. And over a period of time, I realized that the 80/20 rule almost applies everywhere. Like how I figured out in investing that at least the first 7 years of my career, what I used to do, mostly I ended up realizing that it was all a waste of time, because it never really moved the needle. But you ended up spending a lot of time and you felt good about yourself. So I've now come to my productivity hack is that to really figure out few things which really move the needle, and then say that so the idea is to do few things but do them really well. And in most areas in life, I'm moving towards that lens. So my productivity hack is you subtract, and then you simplify, and then in the few things you go as deep as possible.
Oh, wow. Last question, Arun. If you could go back and give your own 25-year-old self an advice, what would that be?
So, see, I unnecessarily complicated it for the first probably 7 years, because I was also a little confused, because this investing world keeps throwing you so many stuff. You're doing stock picking, you're doing sectors, you're tracking the news and all that. But it took me 5-7 years to kind of realize that there's too much of noise, and to identify what are those few levers which actually help you make money took a long time. And then you realize that the more and more simpler you can keep, and the fewer the decisions you can do. And it's a very weird field where the more lazy you are, the more money you end up making.
Wow.
So in that sense, the advice that probably I would give to my, I mean, I don't know whether I could have reached that complexity to simplicity without this experience.
Yeah.
But with whatever I know, I wouldn't have complicated it so much in the early stages. I would have just kept it really simple. Because net at the start, it's only your savings. You just figure out few good fund managers, and then keep investing month on month over a 10-15-year cycle, and be a little contra. You will be through. But again, today also my portfolio is very, very simple. It probably has 4 or 5 good fund managers, and some bit of stuff where I take very high risk on 20-30% of my portfolio. But otherwise, it's a fairly packed portfolio.
Okay.
Within a simple half a page sheet, I can put together my entire names of all that which is there.
Okay.
So yeah, so simplicity is something that and even now, whether I like it or not, somehow or the other, some complexity keeps coming into the portfolio. But yeah, I want to keep it
Super.
more and more simple.
Thank you so much. Thank you so much.
Thank you, Kishore. Thank you so much. Thanks.